Good morning and welcome to this Bloomberg India Edition special conversation. I'm Menaka Doshi. India Edition, as you know, is a weekly newsletter that I author for Bloomberg. It offers an inside view of what's going on in the world's fifth largest economy. If you haven't subscribed yet, please do just scan the QR code that you can see on your screen. Now, if you'd like your news in more frequent doses than just a weekly dose, thanks to the newsletter, then sign up to the Bloomberg India WhatsApp channel. The day's top 2 or 3 stories will be supplied to you there. You can sign up again using the QR code that you see on your screen. One final request, this is some quick housekeeping announcements. For some reason, if this conversation stalls on whatever platform you're watching, refresh is the best way to reactivate it. And we'd love to invite questions from across our audiences, whether you're watching on the Bloomberg terminal, on the website, or on a social media platform. So please post your question there and we'll aggregate it and put it to our special guest today. Now let's get to the topic at hand, the budget. Prudent is how most economists have described it, as the government used the higher than estimated revenue to compress the budget gap or the fiscal deficit, while appeasing key political allies and making some efforts to boost jobs and help small enterprises. But at a time of heightened global volatility, does this first budget of Modi 3.0 give adequate impetus for growth to the Indian economy? To answer that question and to get into the budget fine print, I'm joined today by Sajjid Chinoy, Chief India Economist at JP Morgan. Sajjid, welcome to this special Bloomberg India Edition conversation. Let's start with your 60-second top view of this budget.
Good morning, Menaka. It's great to be here. So I think the 60-second view, as you said, I think of this as being kind of prudence combined with plumbing. What do I mean by that? You allude to the fact that we're living in a hostile global environment. We could have a US election in a few months that can upend the entire global order. Interest rates in many parts of the world are at multi-decade highs, right? So this was not a time for fiscal adventurism of any sort. Also, despite the fact that growth in India was so strong last year, public debt to GDP kept creeping up. So the first order of business was to actually ensure that, macroeconomic stability was reinforced. And we've seen that the government's done that time and time again. Last year's fiscal deficit number was lower. This year's is lower than envisaged. And generally, the government ticked most boxes on the fiscal front. The revenue assumptions for next year are very conservative. The quality of expenditure continues to improve, measured by the ratio of capital expenditure to revenue expenditure. The finance minister spoke about bringing debt to GDP down in the medium term. So I think fiscal prudence, is clearly one highlight of this. There was also kind of financial sector vigilance, where the government's acutely aware that asset prices should not be running ahead of economic fundamentals. But then there's the third part, which I think is the most important part, which is an attempt to try and fix the plumbing of the economy. I've been writing for a long time about how India's manufacturing has become very capital intensive. We all want consumption to pick up. Consumption runs through the labor market. And so boosting employment is the overriding challenge. And for the first time, we saw direct interventions in the labor market to try and redress that capital labor balance. There was talk about factor market reforms and having to work with states. And there was, I think, refreshingly, a cutting of a lot of import tariffs, which would improve domestic competitiveness. So I see this as being the start of a conversation on repairing many parts of the economy's plumbing, which hopefully should hold us in good stead. This is a long road we have to traverse, but at least we've begun going down that path.
I'm glad you brought up employment and those schemes that they announced, both to the extent that the government seeks to incentivize new hires, but also the internship programs. How effective are these going to be, Sajjid? Let's be honest, nobody hires just to avail of a government incentive. And our problem in the economy right now, one of the reasons why we haven't seen private capex pick up to the extent that we thought it would, is that there isn't enough demand. And this budget does not enough towards demand, I would argue.
So, Menaka, a couple of things. Let's step back and just shape the context here, the macro context here. I was surprised that there were plans for the budget to impart a stimulus, because the fiscal deficit has to come down. right? And that's the opposite of a stimulus. The fiscal policy, monetary policy did a lot of heavy lifting in the pandemic across 3 or 4 years. Now the time has come, I spoke about public debt to GDP rising for us to stabilize public debt. So deficits have to come down. Now, when deficits have to come down, prima facie, there is a contractionary impact on activity. So it's the opposite of a stimulus. And the first order was to try and minimize that contractionary impact. So we had to be realistic here that, there was no space to increase expenditure. The question was, how could you minimize the expenditure compression? Now, you're exactly right. I think the investment in India has been driven by the public sector over the last several years. And given that fiscal space is going to be constrained in the years to come, that baton has to pass to the private sector. And the question is, what is the constraint on private investment? Because we've been, bemoaning the lack of private investment for the last decade. But it's important to recognize that the constraint has changed. For the first 5 years of, it was essentially balance sheets, that corporate debt to GDP was high, leverage was a problem. That's now all behind us. Balance sheets are healthy, profits are strong, cash levels are high. The issue, as you said, is demand. Right? Utilization levels are in that 74, 75% range. More importantly, the elephant in the room is there's massive excess capacity in China, which is being exported around the world. So when you have this, all this excess capacity, flooding into emerging markets, then the demand visibility that local corporates need is even higher to invest if you're competing with this behemoth called China. So I agree with you that demand visibility is the key. Now, we've agreed that fiscal and monetary policy don't have space now to inject more demand. So that demand has to come from consumption and exports. Now, consumption has been tepid, and it's been tepid because, ultimately consumption is a function of incomes. And for incomes to go up, we need quality employment. So ultimately, we have to be patient. This has to run through, can we boost employment? Will that over time lead to higher consumption? Will that visibility then lead to higher investment? Similarly, on exports, can we do things to become more competitive so that there's more visibility on exports? Now, I think it's important to stipulate upfront that there is no magic bullet on jobs. I mean, many countries are grappling with this. The question is that we've seen this kind of monotonic rise in capital intensity in manufacturing over the last 20 years. And how does one redress the balance between capital and labor? I think that's the defining question. Now, there's no one silver bullet that's going to do that. It's going to require an entire ecosystem. Can we change the incentive structure between capital and labor? What do we need to do to improve education, skilling, and therefore employability? Will labor laws have a role to play later in reducing the frictions of hiring, firing? This is a whole ecosystem. I'm just glad that the budget has recognized that this is a key issue and started down a path. Now, I agree with you that no one's going to hire just because there's an incentive. You require both demand and labor to be a more attractive factor of production. But at least the second is part of that equation, and we've begun to at least discuss that.
Okay, so how does one, I mean, look, I get what you're saying. It's chicken and egg, demand, employment. Fine. At least they've begun down this path. Fair enough. But how does one understand the viability or the effectiveness of these employment schemes? For instance, if you look at the internship program, given that's to be funded by CSR or corporate social responsibility funds, there looks like that could happen potentially, maybe not to the scale that the budget lays out. But when it comes to the 3 employment schemes or incentive schemes that they've announced, any way to guess whether these work or not? Because several state packages tend to have jobs linked into the benefits that they're giving a particular investor. And those sometimes work because it's an entire package.
Right.
We'll give you, lower cost land, we'll give you, tax benefits, and you need to hire X number of people. I'm not sure this goes down that route, right?
No, this doesn't, and I'm not sure we should be overly prescriptive, right? And you don't want to overly interfere with the market system. Because remember, we ultimately want India to be, so there are multiple objectives here. One is we want India to become part of the global value chain and become more competitive. Now, when you want entrepreneurs to become more competitive, you can't be overly prescriptive to say, use so many units of capital and so many units of labor. What you have to do is create an ecosystem where it is in their interest to pick a ratio that's equitable. So the way I think about this is, again, not to overstate the case, but we've been pushing on infrastructure the last 4 or 5 years. There is an incentive scheme from a production linked incentive scheme. Corporate taxes have been cut. And the hope is that these things over time begin to add up and India becomes a more attractive destination for higher production. Now, when you start producing more, the question is, will you use more machines or more people? And at the margin, this is saying, can we do things at the margin to make that choice less skewed in favor of capital and more in favor of labor? Again, Menaka, I'm not for a moment stating that this is going to show up in 6 months, because ultimately for me, employability is the key. You see, you can give an incentive to a firm, but they will only use the incentive if there is broad comparability between the factors of production, where I can substitute capital with labor. And that substitution means that labor needs to have skill, education, experience. And this is not going to happen overnight. My simple point is, at least we're talking about it. And I'm sure, over time, there'll be trial and error. Some things will work better and we'll scale that up. Some things may not work and we'll have to go back to the drawing board. But it'll require this package, right, of skilling, of education, of incentives, and taking away incentives for capital, that's for sure. And then maybe at some point also labor laws. I think the economic survey makes an important point. This is such an important and complex issue that you're going to need a tripartite compact, right, between the central government, state governments, and industry. And this is going to be iterative over time.
Okay, forgive me my cynicism. Look, at a time when we still have to figure out how to make the public production-linked incentive scheme a success beyond sectors, just electronics. I'm a little skeptical about this ELI versus PLI. But anyways, I want to go back to a point that you made earlier about fiscal adventurism. And I just have a question there. We were already down to 5.6% fiscal deficit, on account of the higher revenue for the last financial year. Could we not have stuck at the 5.1 original target, as opposed to having compressed the deficit even further to 4.9% and use some of that extra revenue, whether it was the RBI dividend or higher than estimated personal income tax revenue, towards other spending in the economy? Not necessarily infrastructure, but something that, offered a demand impulse of sorts.
No, we could have, and
Should we have?
So that again, there are two objectives here. One is pace versus endpoints, right? And now, in other means, what should the end fiscal deficit be, and how quickly do you get there? So I'm of the view that the end fiscal deficit may actually have to be lower than the 4.5%. And I'm very happy the finance minister said she wants to see debt to GDP go down, because that may require a fiscal deficit lower than that. But I agree with you in principle that I think the pace of this needs to be gradual because of where we started, that we're still catching up to our pre-pandemic path, right? And so because we haven't seen private investment broaden and deepen at the pace that we would like to see, it's important that, that the fiscal, not retrench too quickly. And we have done now 1.5% of GDP in central fiscal consolidation over the last 2 years. Only could caveat is central deficit, state deficits widen when the other way. So if you look at the consolidated pool, it's less consolidation. But I agree with you in principle. Now that we've done this, I think it's important not to over-consolidate too quickly. Till there is more conviction that the private sector investment is picking up. I think graded consolidation for longer to reach more austere endpoints is the way I would go.
Graded? Say that again in the last bit. What did you say?
A slow pace of consolidation to reach a more austere endpoint.
But are you saying this is too fast? Look,
no,
I'm trying to
I think
understand whether we've done enough for demand in the economy, or whether there was nothing that the government could do for demand, and this is the best budget we could get.
Menaka, the combined fiscal deficit, center and states, forget about where we're going to, even counting this, that we're 4.9 for the center, we're 3.3% for the states. We're a combined deficit of close to 8%. If you add public sector borrowing, we're 8.5%. That is by no means small, right? Public debt to GDP is 81% and rose last year, despite growth being so strong. So one issue is if you don't consolidate your fiscal now, public debt will go up and then you have to slam on the brakes later. So, again, quibbling about 0.1 or 0.2, maybe we could have done 0.2 less this year and done 0.5% next year. I don't think that's going to fundamentally change things. Whether the deficit was 4.9 or 5.1, I think this is less about cyclical support now, because a lot of cyclical support, especially monetary, was offered in the pandemic. We now have to start facing the fact that there are structural things we need to do to boost consumption and exports. And the reason that I was happy that we're having yeah, I said, the reason that I said I was happy that we were having this conversation on plumbing is we have to get away from this mindset that fiscal can do more, monetary can do more 5 years after the pandemic, and say now, what are the structural fixes we need to boost consumption and exports?
Okay, then let me ask you this question, Sajjid. How far away are we from reactivating animal spirits in this economy? We've been trying to guess this timeline for the last several years now.
Yeah, I mean, listen, we live in a pretty hostile global environment, right? Also, let's not discount what we're seeing globally. We've been through 30 years of globalization, and all of that's now being completely upended. We're in a situation where industrial policy is back in flavor in advanced economies. When we say let's grab a bigger part of China plus one, tend to think of our competitors being Vietnam and Mexico and other ASEAN countries. A lot of it is just the US and Europe, because under Bidenomics, there have been hundreds of billions of dollars of subsidies. So you've already got very active industrial policy in a scale that emerging markets can't hope to match. You've got the prospect of a full-blown trade war if Mr. Trump becomes president in November, right? A full-blown trade war. If the US were to impose 60% tariffs on China, there will be some retaliation, right? And so you've got that prospect. Third, you've got heightened geopolitical uncertainty. And fourth, let's not forget that US interest rates are the highest in decades. Yes, inflation is coming down, but it's gradual, it's halting. So this is a very hostile global environment. And then, of course, the elephant in the room is the Chinese excess capacity. I'll just give you one number to tell you how large this is. The planned, and this is a US Treasury estimate, for electric vehicles, where China is doubling down on, the planned production capacity in China in 2030 for EVs is 70 million EVs, China itself. It is estimated that global sales of EVs in 2030 will be 44 million. In other words, China is planning to produce 1.5 times global demand in 2030, right? So yes, there are things that we should do to boost animal spirits, but we also have to be cognizant of the global backdrop there.
Oh, okay, but I mean, look, I get all the explanations. Do you have any visibility now, post this budget, on when private capex might pick up, or are we still, because of the reasons you described, in sort of a no man's land?
No, I think we'll have to be patient here, because if you're an entrepreneur in India, utilization that's 74-75%. Core inflation is running at 3%, which tells you that there isn't much pricing power, right? And earnings, if you look at not earnings, but sales, top line sales in nominal terms have been in single digits for the last year. So I think we have to be realistic here that the private sector will invest when they're more convinced of demand visibility domestically and globally. And until that happens, we'll have to be a bit patient.
Okay, I should also point out yesterday's Hindustan Unilever numbers were somewhat encouraging. I think volume growth has bounced back to 4% as they've taken price cuts. Some green shoots, I assume there. Look, there was another interesting thing in this budget, and that was the appeasing of two key political allies in order to ensure political stability for this government, which was unable to win a mandate on its own. Now, what kind of precedent does this set, Sajjid? I'm not quibbling about the nature of the spend. It's broadly infrastructure driven. And also, I'm not fully clear on the exact precise numbers, because there's a mix of budget support, the promise of grants, and then a lot of multilateral funding that somehow the budget has, sort of promised to help aggregate for these states. But I'm just curious about what you think of the precedent this sets.
Yeah, Menaka, this is above my pay grade. I'm no expert to talk about coalition politics and the precedent. What I will say is that I think the center and the states have a really important role to work together because the reform agenda that we briefly touched at. So if you think about, when the finance minister spoke about factor market reforms, all of what she mentioned, land, labor, power, right, skilling, all of these involve, the center working closely with the states. So I'm just going to say that the partnership between center and states in the coming years is going to be really crucial if we have to achieve some of these outcomes.
Okay, you're skirting the politicalness of this question, but nonetheless, let me move on to tax. A bunch or slew of changes, some very good ones, like for instance, the abolition of angel tax,
Yes.
which is something, industry has been demanding now for years. So I'm glad that's gone. There's TDS rationalization. That's the, humongous cut in equalization levy, a lot of promises to cut down on litigation. So those are great things. But this capital gains changes left markets disappointed, as you already know, but also people wondering whether, is this the full capital gains revamp that the government's been talking about for a while? Is there more to go? Was this necessary? Was this the best time to do it? And can this be used to quell what some might call too much exuberance in the capital markets?
Yeah. So the way I see the tax announcements is there seem to be two broad objectives. There's one objective about rationalization, simplification. I think the finance minister spoke about the fact that the entire income tax code will be reviewed over the next 6 months. I think that's really important. And I think for me, Menaka, and I'll just digress for 30 seconds, let's not lose sight of the bigger picture. Over the next 10 years, India is going to have huge expenditure obligations, right? The infrastructure is just the physical infrastructure. We need to do much more on health. We need to do much more on education, on skilling, on the energy transition. So expenditure to GDP is going to move up, right? Now, as we've discussed, deficits have to move down. The only way to square that circle is tax to GDP moves up. Now, we've made a good start because last year, our estimate is in 23-24, combined tax to GDP for the first time exceeded 18%, right? But more has to be done. And I would argue that because direct taxes are progressive and indirect taxes are regressive, that the burden has to fall in direct taxes. I would argue personally, as an economist, we need over time, all of these exemptions to go away, effective rates to come down, the base to be broadened to take advantage of the Laffer curve. So now, again, that's a multi-year project, but the fact that we're trying to simplify the system is a start. So I think of the income tax part as being a simplification. On the capital gains things, I've worried for a while that financial markets are getting very exuberant, that the gap, if we're talking about India still being a few percentage points below its pre-pandemic path, consumption, it's been tepid, private investment has to pick up. I find the financial sector exuberance, a bit disconnected from those economic fundamentals. We've seen huge spike in futures and options trading. And I think the recognition is we've spent a decade cleaning up our banking system. This macroeconomic stability that we talk about is hard earned, right? It's taken us a decade to do that. And we don't want to sow the seeds for financial instability down the line. You know what they say about regulators? You must take away the punch bowl before the party starts, right? And so I think yesterday what you saw was an effort to throw some sand in the wheels to try. And I think the message is clear that apart from fiscal prudence, the government's also kind of financially very vigilant at this point in time.
Yeah, look, we could principally argue this for a while now, but I won't. Is tax the best way to sort of throw some water on this fire? I'm not sure. But nonetheless, I want to go back to the broader tax architectural revamp that you spoke of. In that, do you see corporate taxes stay where they are? Do you see them, in fact, maybe even increase? Because right now there is this perception that much of the heavy lifting in this economy is being done by personal income tax and not as much corporate tax.
Right. But now, I think it'll be retrograde for us to undo the corporate tax cut from 5 years ago. If we're, it's inconsistent to say we want to have a larger piece of the China plus one pie. We want to attract more investment into India. We know that corporate taxes around the world by countries are being cut or have been rationalized, and then we raise taxes in the other direction. I think, but you're right. We don't want to put excessive burden on direct taxes as well. So the view has always been, don't tinker with tax rates, broaden the base, take away those distortionary exemptions, right? And I think that's the path we need to go down. There's another path that we haven't touched upon, which is This year, we were beneficiaries of the RBI dividend, which pushed up non-tax revenues. But over time, it'll be nice to see a renewed focus on asset sales, on the monetization of infrastructure assets, on disinvestment as another source of revenue, right? So tax to GDP is one part, asset sales is another part. The benefit of using asset sales over time to reduce deficits and pay down debt is that they're not contractionary, right? Normally, if I'm raising a tax from cutting expenditure, deficit consolidation comes at a cost. It impinges on aggregate demand. The beauty of asset sales is that it's effectively like an asset swap. You're selling one asset to build a road or invest in human capital, which is another asset. So I'd like to see over time that also be revisited. This year, perhaps the need was less because you had this large RBI dividend, which plugged the gap. But over time, I think we should need to
But
come back.
Sajjid, can I argue that this year the market conditions were favorable to being able to divest further, if not entire enterprises, as you know, and some have been on the government's self-professed list for a while now. More stakes, you know, in PSUs that the government could have brought to the market. That just hasn't happened. I'm not really sure why divestment has just fallen off the agenda altogether.
Yeah, I mean, maybe part of it is because, you know, gross tax to GDP is consistently done well. And so we've not seen the need to do it. I mean, every year for the last few years, assumption, no, again, I agree with you. I think this is what we should be doing, which is why I brought it up. Maybe, you know, it's necessity that drives that effort. And this year we had the RBI dividend, gross taxes did well. The government was able to both reduce the deficit and increase expenditure. But I'm thinking over the 5 years, we spoke about the new architecture. Over the next 5 years, I think what the fiscal needs to see is, you know, direct tax to GDP go up, the tax base broaden, we revisit asset sales, and we continue to make crucial investments on skilling, on health and education. Because I come back to where we started. I think the key for all of this for me is employability. That we've got 20 years more on a demographic transition. We have to change that capital labor mix. It's not only about money. It's more than just throwing more money at it, but some of it is going to be adding more resources to make the labor force more employable.
Okay, you know, one final question then. The government has said that, you know, the new medium-term fiscal consolidation path will hereon be linked to a reduction in the debt to GDP ratio. Does this significantly change how we should be looking at government finances, budget contraction, once, you know, post FY26?
I think this is exactly the right thing to do. This is exactly how we should be thinking about the problem. What's the end goal here? The end goal here is to ensure there's no sacrosanct level of debt, right? No one is to say 60% is good and 80% is bad. All we can say is if debt to GDP keeps rising monotonically, that's a sufficient condition for unsustainability. So the first task is to first stabilize debt to GDP and then bring it down. Bring it down, Menaka, because we're living in this poly-crisis world. And so we have to create some fiscal space for the next shock. We have to keep some gunpowder dry. And so I think that's exactly the right approach. What combination of fiscal deficits and nominal GDP growth will it take to bring debt to GDP down? And I think after the next year, that's exactly the way to think about it. If you think of the NKSing committee, the goal in fiscal was always debt, wasn't deficits. Deficits were an enabling mechanism to reach a certain level of debt. And I think we have to go back to that framework now that the shock is fading.
So we should expect over the course of the next year some thinking on what the guidance will thereafter be post FY26, let's say in budgets or otherwise, on how the government will approach this, correct?
It'd be good to have that medium-term road plan to say under a baseline assumption of where nominal GDP is over the next 5 years, under a baseline assumption of where interest rates are, what is the level of primary deficit correction that's needed to put debt to GDP on a declining path? And that should be what drives the pace of consolidation. Again, I agree with you that we should do this gradually because we don't want to pull the fiscal plug too quickly either.
Okay. You know, equity markets were left unenthused by this budget for capital gains tax reasons, I imagine. But the bond market also was quite unimpressed. We saw some minor movement, you know, on expectations that borrowings would be cut more than anticipated. That did not happen. And I think we ended the 10-year where we started the day yesterday.
Yeah.
What do you foresee, from here on?
Yeah. So bond markets actually have done very well so far, because even as US yields have gone up, Indian bond markets have been very well behaved. B, a lot of this was priced in. Bonds had reacted in the run up to into the budget. And C, the reason I think that we only saw a 10,000 cut in dated borrowing, but there was a 1 lakh crore cut in T-bills, was because remember, the long end is going to be well supported by index inclusion to the JP Morgan bond index. That demand for the long end is going to be strong, which is why the government correctly felt, why should I cut long end borrowing? If there's going to be demand for that, let me cut short end borrowing to try to ease monetary conditions of the short end. But I think in generally the sense is that with India on a consolidation path and with this extra demand because of investors, bond yields will not be a real issue here.
All right, fair enough. We're going to leave it there, Sajjid. Thank you very much for illuminating the budget in terms of what could have been and should have been and what we did finally end up with. Sajjid Chinoy there, thank you for your time. And thank you to all of you who've been watching.
My pleasure. Thank you.